Hello there and welcome. Thanks for joining us for FY24 Ready. A very warm welcome to AusBiz for any Market Matters subscribers who aren't already familiar with us. We hope you'll join the AusBiz network for more content like this. It's free. And for the AusBiz viewers here, and perhaps not familiar, Market Matters is a data-backed digital advice platform that offers insights into the market and timing and plenty more besides. So the two of us are very excited to have come together to bring you this exclusive investor event, which will leave you, we hope at least, with some ideas to help make you money. And just mind the disclaimer, of course. Now we have James Garish, who is the lead portfolio manager for Market Matters, here with us in studio. Welcome, James. So good to have you here.
Thanks for having me today. Great to be here.
Yeah, we've also got Ben Clark, of course, who is a regular on AusBiz, and he's from TMS Capital. Really appreciate you being here as well.
Thanks for having me. First time on Market Matters, so that's good.
Yeah, great.
Plenty more.
Right, and joining us, we do have Marcus Padley, who is joining us from Marcus today. So really a warm welcome to you, Marcus. Thank you for joining us. And we have Nick Cadera as well, who's joining us from Eli Griffiths. So great, let's get into it. We do, of course, guys, really want to get to the stock specifics. That's what we know people love, and obviously your expertise. But I do think it's worthwhile to just set the scene because we're entering this new financial year. And James, you know, we keep hearing, we heard it most recently from the Future Fund, that this is very much becoming a time for active management, that this is very much a stock pickers, bottom-up market. So, you know, set the scene.
So I think, there's a lot of talk and concern around the market in terms of, interest rates and all the macro gyrations that are playing out. But if you take a step back and think about the various asset allocations that we as investors put in the portfolios, you think about bonds, 10-year US yields are now 3.5%. 3-4 years ago, they were at low levels that you couldn't really invest in. You've got equities back to average PEs, both here and overseas. You've got corporate debt that's now paying attractive returns at investment grade credit at 6%. You can go up the risk curve a little bit and invest in a CBA hybrid, for instance, that was out this week at near 7%. So I think that the actual backdrop for investment going into FY24 is a really interesting one. It's a good one. 3 or 4 years ago, equities were the only thing in town, and that forced people to go up the risk curve when they perhaps shouldn't have. So now we can create some really interesting, well-balanced portfolios that are getting good returns.
Ben, interesting, exciting. Is that how you read, the backdrop to this investment horizon?
Yeah, definitely. I mean, like James said, there was, the old phrase, Tina, there is no alternative. That just played out for 5 to 10 years. And he's right, this year's the first year you can start to get almost equity-style returns in assets that aren't classed as equities. So there is an alternative now. It's probably meant that the hurdle rate to be in shares has lifted somewhat. But we have, this year's been amazing because we've actually had a pretty good start to the year. There's so much negativity out there. There's a lot of things to be concerned about, but the market seems to be climbing that wall of worry in a way. Certainly it's been more the case in America, which has bounced back harder after a much tougher year than the ASX had last year. So I'm sure we've got a lot of questions because there's a lot of concerns, I know, but I definitely think we've seen a lot of rotation in the market in the last financial year, and I think that's going to continue to be the case.
Okay, well, let's see if Nick agrees with that. Nick?
Look, I think right now the market's at a pretty interesting juncture. I think it's probably too late to add to defensives. I think you've seen, as Ben and James have referenced, the S&P's up 8% year to date, Nasdaq's up almost 20%. So we have had a strong recovery in US markets. In my world of small caps, you've still been lagging a little bit, and traditionally small caps lead the recovery. So that to me suggests that there may well be 1 or 2 more tests of the downside. But I think from where we are today, the composition of the market looks a lot different to what it did in the last calendar year. Resources have roared back on the China reopening and then subsequently given up a little bit despite the US dollar being weakening. At a macro level, I think the US economy does not appear to be in a recession right now, but inflation does remain relatively sticky, which probably suggests that you're going to see a higher interest rate environment for the time being. So there are some cracks appearing, things like the US banks expected to tighten lending going forward, the China reopening, which is sort of faltering. But I don't think there's enough cracks yet to be too concerned, and the markets are suggesting that we perhaps have seen the worst of it, but I wouldn't rule out a retest of the lows perhaps later this year. But I think you need to be invested in this market, otherwise you will be missing out.
Marcus, do you need to be invested in this market, in equities? I mean, we know them, we love them, but to James's point, and Ben as well, there are alternatives, and that does include cash.
Hi, Nadine. Hi, everyone. Look, with respect to my esteemed colleagues on the panel, I'm the sort of guy that a journalist rings up on Christmas Eve and says, Marcus, what's your prediction for the year? And I'm usually there because I'm a bit of a loser and only the losers do that graveyard shift. So I have found myself predicting the market on January the 1st in The Age and the Sydney Morning Herald before now. And I can tell you, the other people on that panel are usually someone from the awesome foursome, a dartboard, a monkey, and an astrologer. And I almost always seem to lose. So I long gave up predicting the stock market, and I think it's a bit of a joke. I think also the Australian market is a bit of a laugh because you've got 25% of the market in banks, which have got their own mind and a completely different mind from the 25% that's in resources. And then you've got 50% which is exposed to an economy run by 25 million people, which is hardly significant. So I think trying to group them all together and predict where they're going is a bit of a joke. I like to view banks as great income stocks and resources as great trading stocks, and the rest of it is a stock by stock basis. So I was asked by a journalist to predict the year ahead, and I said plus 14%, because you've either got to own the downside or own the upside. And 14% was the standard 9% every economist predicts every year, plus the 5% we lost last year. So I thought we would catch up this year, and we seem to be doing that.
All right. Well, lots in that. Right, a reply, James.
I think Marcus makes a great point. I think, and you alluded to it at the start, Nadine, around active investment, and we've seen it in the last 12 months. And I think, as Ben made mention to, we'll see it again in the next 12 and onwards. There's a lot of diversion between things that have got tailwinds and things that have got headwinds. So I think, to Marcus's point, you want to be invested in the things that have got tailwinds. Stay out of the things that have got headwinds, and do your best to position portfolios around that. Not just this. I doubt the buy and hold of index funds is the place that you want to be in the next couple of years.
All right. Look, let's get to the stocks, shall we? Everybody's chomping at the bit, but let's go to Nick at Eli Griffiths, just to get your view on some stock specifics. Nick, what's your first pick for FY24?
Oh, look, I think in terms of the sectors that I think are probably the most interesting are things like gold, and probably things like those stocks that are growth at a reasonable price. So I've kind of picked two stocks that I think kind of fit that mold. The gold stock that I've picked is Capricorn Metals. Gold prices are bumping up against all-time highs. Aussie dollar gold price is close to $3,000 an ounce. The founder in Capricorn Metals, Mark Clark, has grown this company from what was very much a presentation to an incredibly efficient operating gold mine in Western Australia, producing north of 100,000 ounces per annum. They consistently produce free cash flow per quarter on the back of strong operating margins. They've got growth optionality in the Mount Gibson Gold Project, which they just released the PFS to the market a month or so ago, which would add a further 150,000 ounces of production for the first 7.5 years. I think what's interesting about this stock, it's expensive, but it has one of the lowest cost profiles of gold stocks on the ASX. It continually produces free cash, and it does have a bit of a management premium to it. On the other end of the spectrum, I've got an industrial, which is Monadelphous. Mining services is a typically cyclical industry and often used as a proxy by some investors to play commodity prices because mining services clients are obviously the large commodity producers. The sector has had its fair share of challenges over the years, particularly given things like COVID, labour restraints, particularly in Western Australia. They've also had margin pressure, and a number of contractors over the years have gone broke. So they are particularly difficult business models because they operate on relatively razor-thin margins. Our view is if you are going to invest in the sector, you need to invest in the best, and Monadelphous is arguably the best engineering and construction contractor out there that we believe. If I look at the reasons why, they mainly deal with tier one contractors. You've got about $40 billion of iron ore capex that's likely to be spent over the next couple of years out of the majors as they replenish some of that existing supply that they're supplying to China and other markets. Monadelphous won't obviously be exposed to all of that, but they are very well positioned both in iron ore, lithium, and in rare earths. Given their track record of delivering projects for tier one miners on time and broadly on budget. Year to date, this company's won sort of north of $1.6 billion of work, and they're very confident around the outlook for FY24 and how that business is positioned.
Okay, so there's your investment thesis for both of those companies, which was Capricorn and Monadelphous. So let's backtrack a bit, because we did have a lot of questions coming in, guys, from our audience leading into this day about gold. James, I know that you do have exposure to gold in Market Matters portfolios, but would you view Capricorn? I mean, why not just stick in the big end of town?
Yeah, that's a good one. So it depends what portfolio you're looking at. So Nick's running an emerging companies portfolio, and there's some really valid reasons why Capricorn, and we've looked at it and we like that story. We've stuck into the bigger guys. We've got Newcrest, which is obviously under takeover at the moment, and that's likely to go through an evolution. But ultimately, as an investor here, you've got to have a view on the gold price. You get the gold price right, you're going to go a long way to making money out of gold stocks. So I think it's sitting just under 2,000 an ounce at the moment. I think probably in the very short term, gold is probably a little bit muted. I think the US dollar is at, it's been weak in the last 12 months or so, but it's at risk of bumping up on the upside, and that'll put a bit of pressure on gold. There's a few short-term factors at play. So, but I'm reasonably bullish on gold, but we are trimming some of our holdings at the moment. So more on the sell side in the short term, but a medium-term bull on the gold price.
Marcus, gold. Are you rolling your eyes at gold as well?
I would just point out something with resources and Australian stocks that you have to understand in Australia. There are some stocks that are highly correlated to their underlying commodity price. And as I bung the chart up here of CMM relative to the gold price, it's got all exactly the same turning points. So in other words, if you can't get the gold price right, you won't get the stocks right. And as far as the gold price is concerned, I have thrown myself on the rocks of trying to get the gold price right in the past and failed miserably. So I don't pretend to try and guess it. I do know the main drivers are things like inflation fears, and the regional banking crisis saw gold going up. So it's a sort of disaster commodity. I don't really have any view on where it's going. I can find things with less volatility and more reliability and more drivers into the underlying commodity price that are more predictable than gold. I've been burnt 1,000 times trying to be clever, so good luck to you all.
Well, Ben, do you have to have some allocation to gold? Would you do it via Capricorn Metals?
Look, you don't have to. We don't, which has probably hurt us, I guess, in the last sort of 6 to 12 months. But I kind of think in the short term, it is very, like Marcus is right, like predicting the gold price is very hard, but it feels like the sort of the safety net that everyone's gravitated to. Inflation pressures are easing. They're not easing as fast as we probably hope they are, but they are easing. We're probably moving into a turning point in the rate cycle in America, which is really what's going to drive the gold price. And the banking sort of stuff, debt ceiling, I'm pretty confident that we're going to move through that. So, look, I think it doesn't hurt to have it as an insurance policy, but we don't own any of it.
You've got to think about where they've come from and where they are trading at now. So Newcrest is at $15 and it's now near 30. So there's been some really big gains playing out in the sector. So that's why it's easy to understand why you're a little bit ho-hum at this point in time.
The Newcrest will be interesting because it's going to be, I'm guessing that'll leave the index as it becomes a CDI, which will mean that there's probably a lot of money that could flow down into those next tier of golds.
In the Aussie index, but
index.
there'll be a higher weighting internationally.
Yeah. So, maybe there's some funds that'll be looking for things like Capricorn locally. I think what Nick does, I know, is, you really got to get out, you've got to tread the ground around that mine, you've got to meet the management. Mining is a very difficult thing, and there seems to be a collection of a few management teams that have got really good track records, and I think half of it is backing the right people.
Yeah, well, Nick, talk to us about that. What about Capricorn? Its management? I know that it maintained its production guidance and cost guidance as well. I was surprised in the most recently round of quarterlies coming from mining companies that some of them were still talking about these cost pressures and labor cost pressures in particular.
Yeah, I think Ben's right. I mean, there are a select few of quality management teams that ultimately are going to, be the ones that investors flock to, and I think Mark Clark and his team there have clearly been a standout in terms of a track record of bringing a mine from literally a presentation to an operating mine that's generating sort of 30 to 35 million bucks of cash every quarter consistently. I think why they've been able to do that is because they've had a disciplined focus on costs, and there are still cost inflation that is causing issues in the industry. I think you saw this morning, Beach Petroleum indicated that there were cost blowout for their Waitsia project, and I appreciate that's not gold, but it's in the same region. And I don't think cost inflation at the project level is going away anytime soon. I think it is more manageable because the management teams that are skilled are getting used to operating within that environment better, and ultimately, I think Capricorn's one of the better ones that has been able to prove that over a long period of time. And ultimately, if the gold price does drop, which what a number of the other panelists are indicating it may do, you want to be protected on the margin side. So having the lowest cost operator means you'll ultimately be one of the better performers in a falling gold price environment.
All right, Capricorn, that is the idea. CMM is the ticker code. So let's get on to your second stock, Nick, that you also outlined, your base case for Monadelphous. It didn't recently make an acquisition. What do you make of that? I think it's for a group called BMC that operates out of Victoria. Is that a big positive for you?
I think it's at the margin. It's more of a bolt-on, to be honest. I think the reason why you're there is for that pipeline of work in FY24. And seeing this webinar is all about FY24 Ready, I think it's a great stock to have exposure to a growing earnings pipeline in FY24 as a result of the orders that they've already taken in FY23. I think the reason why you're there, as I kind of outlined, is it's a difficult industry to get right. It has borne the brunt of a significant amount of labour cost escalation, labour availability, and ultimately these tier one miners in BHP and Rio and Fortescue all need to build their iron ore mines. We've got a significant amount of lithium projects in the pipeline that need to come to market. And ultimately, Monadelphous is best placed to win a significant chunk of that work. And they've already demonstrated in FY23 that they have an ability to do that, with further work still to be awarded in the coming months. A lot of that work was delayed over the last couple of years, as just like anything in this world in the last couple of years, there's been delays to projects and delays to getting resourcing to get projects up and running. We're now starting to see those approval processes coming through more regularly. We're seeing new mines being financed. And I think Monadelphous is particularly well positioned. They also have a really strong maintenance business, which has delivered a lot of the earnings and revenue, while that construction and engineering business has suffered, I suppose, over the last couple of years. We expect that to continue, but it's sort of a mid to low to mid single digit growth kind of business. But oil and gas capex is picking up around the world, particularly in the maintenance side of things, and we think Monos is very well positioned to pick up that ongoing maintenance work as well as these new projects.
It's easier when you're thinking about mining and mining services, and you need to set the backdrop about what's going to drive new investment in the space, new holes being dug in the ground, and it's all around economic growth. And we all sit here and say we're about to go into a recession, and the US economy is tinkering on the precipice of one. But if you think a little bit longer term, things that drive economic growth are population growth, urbanisation, and those two trends are massive. So there's going to be another billion people on this planet in the next 15 years. A greater proportion of those are going to live in urban centres. That another billion in the next 15 years. So all of those things drive new development in mining. You think of, Nick just touched on it there about the energy transition and decarbonisation. There's going to be a fourfold increase in money being spent on energy projects in the next 30 years. So all of these things are really supportive of companies like Monadelphous, Worley Parsons and a bunch of others. And Nick made mention of another aspect there is some of the smaller guys have gone out the back door. So the stronger ones are surviving. So I think that's a really, thinking bigger picture, longer term for a second. I think that's that's a key driver and why, for us, we're bullish on the mining sector and the associated services.
Mm-hmm. Maybe a question for me, because we've been in Monadelphous in the past, is the earnings are very cyclical. The share price, as we saw those longer term charts, moves around a fair bit. So maybe a good question for Nick is, when's the time to sell an investment like that? Is it a stock that you want to hold, for a very long period of time, or what are you looking for to tell you that it's time to get out down the track?
Yeah, Ben, I think it's all about execution, and often the time to own these stocks is when they're actually winning the contracts, because at that time there's not a whole lot of risk around what they have to deliver. Clearly, they're delivering their order book from the years prior. But if they're growing their order book like they have this year, I think it's up 11% versus FY22, then there's even more pressure on management to deliver to those contracts. This is an industry that has relatively small margins. So a challenge in a workforce or a delay could mean that their profitability suffers on a particular project basis. So I think ultimately when you want to sell these contractors is when that pipeline starts to slow down again, and the new work is becoming harder to replicate, and you're relying on the execution of the existing contracts to drive the earnings. I think the market will pay less from a multiple perspective for a business that has a slower contract win rate going forward than what they'll pay as that order book is currently filling up.
Look, I just wanted to pick you up on something then, James, because you did mention Worley Parsons there. Is that an FY24 ready stock, so to speak?
Yeah, absolutely. I mean, the bigger picture trends I just spoke about, the huge uplift in spends towards decarbonisation, that's going to drive a company like Worley. I know Nick was just talking about margins and all of that. These are tough businesses, and Marcus, I no doubt, will be sitting there saying, why are we bothering in these difficult stocks when we can go and buy something that's growing as a lot simpler business. But it's all about these will improve. So to Nick's point around margins, you want to be buying something and holding something where margins are going up. Labour pressures have been an issue, but and they'll continue to be an issue. But when you move, someone like a Worley Parsons is moving from sort of lower margin maintenance businesses into higher margin engineering type businesses as we roll out these big decarbonisation projects globally. So it's going to be a bigger market. They're going to take market share, and they're going to improve their margins because of the focus more on the higher value parts of their operation. So those multiple things combine and say, earnings could be, if I look 4 to 5 years out on a Worley Parsons, earnings could be double where they are now. So I think that's an absolute, it's a buy for FY24.
Okay, let's give Marcus a little bit of a look in. He can speak to us himself. Decarbonisation. So if you think about a stock like Worley, which James has just listed, I mean, that's a massive tailwind. The energy transition is happening. It's a train in motion and not going to stop. Do you not think that that would be good for some Aussie listed stocks?
If you say so, but I do think I'm running a daily newsletter. I have members who are sitting at home looking after their own money, and despite what you might think, my demographic, which is 70% over 60, they tend to be, they're not long-term investors. As one member once said, what is it with you brokers that think all us old people are long-term investors? According to my actuary, I've got 3.5 years left to live, and yet you're telling me about Telstra's 5-year plan. Okay, so I think I have to make money on a shorter time period for our members. And I hear your big themes that run, and I can see a great trend in Worleys. And yes, that might be thanks to carbonisation. But I've always seen Worleys and most resources stocks as trading stocks. And Worleys is actually one of the best ones, and it has a very, justified or not, very high correlation with the oil price. The oil price has quite significant pivot points. And I would be playing Worleys for that exposure. I'm really not interested in sticking Worleys in a portfolio for a long period of time. That's not my gig. Buying 20 stocks and making predictions. So Worleys, I would say, is a trading stock. It over a long period of time, it's not a bottom left to up to top right stock in the long term anyway. Its returns over the last 10 years relative to the market have been pretty shabby. It's not a quality, reliable earnings stock as you can find elsewhere in the Australian market. So trading only, and I don't know enough about it to tell you that Worleys is a great long-term investment. I leave that to smarter people. I would be trading it on mostly the energy price pivots, and I wouldn't be in it at the moment.
Okay, so good point. So, Worley and energy, is there a danger in becoming a little bit over-optimistic about the sustainability piece just yet? I mean, because you could still potentially get upside just based on that thesis.
Yeah, you could. So just going back to Marcus's point around how we position in stocks and portfolios, etc. So active management, I'm very much not in the corner of buying 20 stocks and holding for the next 10 years. That's not what we're all about. We're looking at a shorter time frame and trying to identify catalysts that will drive a share price based on, you want a longer term thematic at play, then you want the shorter term things that the market cares about, what matters to the market. And in terms of Worleys, it's about them executing on improving margins in their business. So they've articulated a pretty credible plan, I believe, to grow margins in the next 12, 24 months that will, in my view, drive the share price higher. So I don't think Worleys, I know saying it's different than what it has done in the past, but its correlation to oil price, I don't think is going to be as high moving forward. You've got to move forward. Worleys, 40% of their backlog is now associated with decarbonisation projects, not the maintenance asset, not the maintenance business that was servicing oil refineries and the like. So I think that will decouple more from the oil price, and there's a better story than the story that's been played out in the past. And I think that's really important, is not anchoring yourself to what you have seen in the past, thinking about what a company can do in the future is what's going to ultimately drive its share price.
Quick thought on Worley.
Well, it's definitely decoupled recently, so that the market's seeing a change in the earnings composition going forward that James has spoken about. I mean, I think it looked like it was getting close to its year highs. The oil price has been quite weak recently over the last 12 months. So clearly there's some buying behind it. Like these contractors, Monos, Worley, they've gone through some really good periods. I can understand the logic in buying them now, because I think when you look back, you'll sort of say we were close to bottom of the cycle margins at this period. and the market does seem to be coming back to them. So it looks pretty good.
Okay, let's move on from Worley. Now that I'm on you, James, let's talk about your next FY24 Ready stock. What have you got for us?
I've got Sandfire and Marcus. This is more of a trading stock. So, back to how we look at the market, we want a long-term driver, a long-term tailwind, and then we want to try and pick the ebbs and the flows in the stocks that you want to be involved in. So, Sandfire, copper producer, going back a couple of years, they've had some challenges around mine life, etc. They've been ironed out, and since Oz Minerals has been taken off the board, taken out by BHP. Sandfire is probably it. Now that's not a reason to go out there and buy it, but they've done a good, they've made some good inroads operationally, and I look at the copper price over the next 2, 3, 4, 5 years, and once you get through this period of concern around the economic growth, etc. I can see higher prices for copper. There's been not a lot of new development put into the ground. Major copper finds are harder, they're deeper, they're more expensive. So the ones that have already been found are going to be more highly valued. And you can see that why BHP's bought Oz Minerals. They paid up for Oz Minerals. They could have bought it a lot cheaper many years ago, but it's clearly going to be a big component within this decarbonisation thematic, which I don't really want to continue to harp on about because it's not the only driver. But I can see, we're in the market buying Sandfire today.
So today. So it's off its highs, but still, I mean, the share price has been a performer over the past year. So still plenty of room to grow in FY24.
Yeah, I mean, it's one we've got really right. So we bought it at low levels around 4, sold it above 7. And now starting to accumulate it back below 6. Now that doesn't happen in everything we do, let me tell you. But it's one I think we've got a reasonable feel on, and one that I think in the next 6 to 12 months we can make money out of by accumulating it on the back foot and taking that, not knowing that we can get it on the day or the week at the lows, but averaging in the positions over time and then trimming things when things are optimistic. I would argue things are pretty pessimistic from an economic standpoint at the moment. We've got this concern about a recession that's playing into copper prices. So this weakness, I think, in my view, is a buying opportunity.
Well, I just would like to acknowledge our audience. Thank you for sending in all of your questions, and you did so ahead of time as well. So this one's for Sharon, and it's just because we're on the copper theme, so way to open it up to our other guests. Sharon says, given that there are limited exposure to copper producers on the ASX, I mean, Sandfire is one, would you recommend the Wire ETF, assuming you agree with the bullish copper sentiment? Look, we're talking about stock specifics and active management, but Nick, just to go to you on the copper thematic, I mean, is there, in your view, a real bullish outlook for the commodity and any preferred pick?
Look, I think copper's an interesting one. It doesn't seem to trade on fundamentals very often. It tends to trade more on the macro environment. And as James referenced, you've seen the copper price fall in the last couple of months on, I suppose, deteriorating macro sentiment in the US, particularly around a potential recession or not. I think copper longer term certainly has some interesting thematics attached to it. But I feel like the world's been a bull on copper for a long time because the supply-demand scenario fundamentally just hasn't materialized. You haven't seen a whole lot of new incremental supply into the market, while the forecast demand, whether it be from the EV transition or whatever else it may be used in, continues to accelerate. So BHP is clearly setting its portfolio up for future metals and has acquired Oz Minerals on the back of it. Sandfire, I think, is the next largest liquid pure play copper stock in the market. And there's actually very few copper mines beyond or copper miners, I should say, beyond Sandfire, particularly pure play, that are of any scale that would appeal to either larger miners, or potentially that have significant challenges with them, i.e. they're very old mines that require a lot of capital investment to actually grow them. So at the moment, there are some smaller miners that are consolidating those copper mines that are out there and trying to bring new projects to life. But I think realistically, copper is a macro trade for the foreseeable future. I think if you want to take a longer term view on copper, you need to allocate to your portfolio accordingly, because the macros are probably going to outweigh the longer term fundamentals for the next 2 to 3 years, or for even longer.
All right, just quickly, Marcus, any interest in the Wires ETF? Why would an investor need to play the copper space that way?
Because they're a chicken, Nadine. If you look at what Samphire has done when the copper price was going up recently, it practically doubled. If you look at what the Wire ETF holds and what it does, it has recently dropped from $12 to $11.40. It's holding 5% stakes in things like BHP and Sumitomo and Glencore, and it's a really diversified, ungeared exposure to the copper price. Samphire, on the other hand, is a fantastic trading stock if you can get the copper price right, and again, picking the pivot points in the copper price. And James has caught this fabulous run recently, but I wouldn't be making any forecasts about where it's going to go or being too long term about it, because the copper price is unreliable. At the moment, it's coming off quite sharply. I'd be out of Samphire, but it depends what you want. The Wire is boring. Samphire is sexy.
Hey.
He makes a very good point, Marcus, and it's around. So he named a few of those stocks in there. So BHP, I think it's about 20% of their earnings are coming from copper. I think Glencore is like their main commodity is coal that they make money out of. Teck Resources, same. They've got a big coal business. Copper's only a very small component of it. So if you're buying Wire, you're getting a whole bunch of commodities, not just getting copper.
All right, Samphire, any quick thoughts?
My only query on it is, it was a big leap to go from a West Australian copper producer to operating out of Spain and potentially in Africa. So I probably just, for me, want to give it a few more months just to make sure that mine's sort of operating as they perceived it to be. It's a fairly new purchase for them. I don't think you can go past the copper thematic long term. Ivan Glassenberg, the head of Glencore, said the world's producing 30 million tonnes of copper per annum at the moment, and by 2050 it's going to need to be 60 million tonnes per annum. And we don't have the supply coming online. I think at some stage the price will overcome the short-term macro. When that happens, hard to know, but having some exposure makes sense.
Yeah, all right. So look, that was Samphire and Worley from James Garish, Market Matters. Ben, let's put you under the spotlight, okay?
Yeah.
So thinking a lot about FY24, talking to clients a lot about what to do. When you think of opportunities for the year to come, where do you go?
Yeah, look, I've got a couple. They're quite different businesses. One probably well-known, one not so well-known. I'll start with the not so well-known.
Okay.
Is Datira Royalties, which was spun out of Iluka a couple of years ago. It's probably not well known in that royalty businesses are very tightly held, generally by private families in Australia. It's a lot of mineral wealth is in some of the famous names that we know of, and this is one of the only listed ways that you can get exposure in Australia to a royalty co. Now, Datira owns a royalty over what's called Mining Area C, or the MAC, which is a mine that BHP operates, and about 2/3 of BHP's total iron ore production will come out of this mine. It's gone through a significant expansion, which is called the South Flank. So they've opened up ground to the south, and they're now producing about 150 million tonnes per annum in FY24. It should get to that sort of number. And the MAC gets 1.232% of every dollar of revenue that comes out of this mine, and that's all they do. It's probably one of the most simplistic businesses I've ever come across. They've got a staff of 20 or 30 people. I don't know what they all do. They literally get sent a check by BHP.
Well, that might not be a great thing.
Well, yeah, look, I mean, I'll get to that.
Count the money.
Count the money. Well, they bank that check each quarter and pay a dividend. But look, it's got some incredible financial things. I mean, the closest thing that we can look at, there's a business on the Toronto Stock Exchange in New York called Franco-Nevada. It's the largest listed royalty company. That business trades on a PE of about 43 times earnings. Deterra trades on a PE of about 13.5 times earnings. It's got no debt, it generates a free cash flow yield of about 8%, and it pays a dividend yield of about 8% fully franked, so it's got a 100% payout ratio. So for an Australian private investor, that's getting close to 11% in total income. It's got a rising production profile in the next year or two, and then it's going to cap out at about 160 million tonnes. And this mine is slated to continue to produce until into the 2070s. So this is a very long life mine. Now, if you look at, I think in some ways you can almost look at this business like an infrastructure stock. It's almost like a toll road, but the beauty of it is there is no capital intensity whatsoever. They don't have to spend a cent of money to generate more revenue. Now, what are the risks? The biggest risk is the iron ore price, because if the iron ore price drops heavily, the royalty payment is going to be lower, and vice versa. And the numbers I'm quoting on are about $110 per tonne iron ore price. So you probably, if you're negative iron ore, you wouldn't want to be in this business. Mm-hmm. But when I look at it, one of the interesting things when you look at Franco-Nevada is most of the royalty companies globally are done on profit and not revenue. There's a big difference with that, because profit can change significantly, revenue less significantly. And secondly, a lot of the royalty streams are quite short life. So, they might be 7 years or 8 years, and then they've got to be replenished. So to me, it's probably one of the highest quality royalty streams that you'll find in mining, and trading on a very reasonable PE. It's got no debt. So we think at this price, it's had a pullback, looks good.
James, do you own it?
Don't own it. Have looked at it multiple times, and it comes down to your view on iron ore in the very short term. So completely agree that the economics of that stacks up. If you've got iron ore price at 110, you've got iron ore price at 95 in 12 months' time, the stock probably won't go up. So that would be my only reservation in the immediate term.
Mm-hmm. Nick, are you familiar with Deterra Resources? We're all being very polite here. You're going to punch some holes in this thesis?
Yeah, I'm familiar with it.
Put the boot in,
I
Nick.
think if you want an iron ore company, buy an iron ore company. If you want a business that looks more infrastructure, buy an infrastructure company. But I see the merits of what this business can do. I suppose my question is, what does it do beyond this particular royalty? Do they do acquisitions? What's the strategy beyond just taking a check each month? Or is that the strategy? I don't know the answer to that one, Ben.
Yeah, that's a good question. So, and I reckon that's the biggest threat, is that the management feels the urge to go and do something, because they're not doing a lot. So they've
those
got
20 or 30 people.
Yeah, exactly. So there's a line of credit, Nick, 250 million. I think they've got 30 mil in cash. They've got no other debt. The line of credit's undrawn. They've said that they're keen to diversify this royalty stream into other areas. They've spoken about battery, lithium, etc. Since it's listed, they haven't done a thing. Now, I would put that down to the fact that capital markets or share markets in that area, it's been very easy to raise capital. We've seen it's probably been the one area where you look at the Allchems, the Pilbras, etc. The share market has been very happy to hand over capital to these guys, and they haven't had the issue of, do we take on debt? Mm-hmm. Do we really dilute on more heavy equity raises, or do we look to get some capital and let someone take a royalty over the mine that we're going to operate? So my thesis would be, don't do anything, because I think if you look at the numbers, this investment pays itself off in 11 or 12 years, and then you still own a 60-year royalty.
Okay, so that's Deterra. Now, let's talk about your next pick, because talking about a company that could continue to do something would be your next pick. Yeah,
so this is a well-known name. This is Wesfarmers, but I think it's well-known because we all know Bunnings, and Bunnings is 75% of group earnings. You've got Kmart, you've got Officeworks, and then you've got some smaller business in there. But what I think is less well known is that Wesfarmers is going to look like a very different business in another few years' time. They bought a company called Kidman Resources back in 2019. And once it disappeared into the Wesfarmers mothership, we really haven't heard anything about Kidman and the Mount Holland asset.
This
that
is
they
lithium,
discovered.
just to be very
This
clear.
is a lithium asset.
This is answering all the questions that we had coming in and have coming in about lithium.
So SQM and Wesfarmers have a JV over this asset. They own 50% of this mine each. And in February at Wesfarmers' result, I think they sort of surprised everyone by actually spending quite a bit of time talking about this because it's getting very close to going into production. This asset's in West Australia, tick. It will be the 6th or 7th largest lithium asset globally that's in development or in production. So we're talking big scale here. And what interests me is that I think when I look at the analysts' work on this company, they're still slow to start factoring in what is going to be a material change in the earnings outlook. So Wesfarmers this year should generate about $4 billion in EBIT as a more retail-facing business. And if you look at a couple of the analysts that have started to look at the numbers on this asset for Wesfarmers' 50% share could be generating between $1 and $1.5 billion in EBIT from FY25 onwards. There'll be some earnings contribution next year as they ramp up, and it's going to really kick in 1.5 years, financial years' time. I don't think the market's factoring that in yet. One thing I learned on mineral resources was the market can factor it in late, but I can tell you it's going to be material. So I think it's one that looks pretty good to me.
One of the true conglomerates, and now getting into lithium. But would you ever buy Wesfarmers, James, for its lithium exposure yet?
Yeah, we own it. One of the reasons why we do own it. Obviously you take a really successful business and you leverage those cash flows into other areas that, to Ben's point, I don't think analysts are really focusing too heavily on that, that component of the business. So I look out and, completely agree with Ben's rationale around it. Okay,
when we get to viewer questions, we might talk about the discretionary spending side of the business when it comes to Wesfarmers, but that's Ben's pick, Deterra Resources, or Royalties, I should say, and Wesfarmers. Let's get to Marcus Padley, sitting over there patiently in Melbourne. Look, Marcus, you've come armed with a couple of ideas for FY24. We're talking active management, and I see the FANG Plus ETF on your list. What's up?
Well, Nadine, I was born in 1961, all right? That was 6 years too late. You had to be born in 1955, which is when Steve Jobs and Bill Gates were born, to be there right at the beginning of the computer age. It was too late by the time I was born to write an operating system 20 years later because it had already been done, and I missed that industrial revolution. And I was offered computer science as a subject at school, but I thought it would be cool to do geography because I thought it was cool to do as little as possible. But no doubt everybody who went into computer science and printed those Babbage cards has gone on to effortless wealth. So if there was a regret in my life, it was not being born 6 years earlier and being in the same space as Bill and Steve.
But you wouldn't have your youthful good looks still, Marcus. So why the FANG Plus ETF?
Yeah. So amazingly, we are on the brink of another industrial revolution, and I'm alive already to take advantage of it. And it is, we can't go a whole webinar talking about crusty old Australian stocks without mentioning the AI cloud revolution that is clearly upon us. It's not a fad. This is exponential growth. I suggest everybody in the stock market watches as many TED Talks as they can about AI, what it's doing, where it's going. But what I can tell you is that there is going to be a perpetual need for the cloud, and we all need to be invested in the next industrial revolution, which is AI. And the stocks that are in the cloud and stocks that are in AI are the same stocks. And in order to build effectively a human brain, which is not really what it is, but to build a brain out of silicon requires GPU farm upon GPU farm upon GPU farm, and we need to be involved. So if you look at the FANG ETF, It has got all the required stocks that you need to get an exposure to the cloud and AI, and that includes Google, Facebook, Microsoft, Amazon, the main players. You can't do AI if you're a small company. And in the cloud, it's Amazon, Microsoft, Google, IBM, same list. So the FANG gives you an exposure to that. We have got in our strategy portfolio, which is only ETFs and is designed to communicate themes and market timing. 90% of that is now invested in the US markets, in the recovery in big tech and the future for AI and the cloud. And my individual stock pick was Microsoft. In order to take advantage of this opportunity, you need to have a huge balance sheet. You need to be able to pick off anybody with a good idea, and you need to be able to weather it through the no earnings period. But the reality is those Microsoft results recently surprised the market. Can you believe one of the biggest companies in the market surprised how many analysts analyze it and surprised them with cloud revenues, which were up, here we go, where is it? Cloud services up 27% in their recent results. And that is just an extraordinary growth rate, caught people by surprise, and it's going to continue. And Microsoft is at the pinnacle. If you go to look for AI ETFs, you'll find these odd ETFs with a whole host of companies that don't earn anything yet. Yet here we are with the most obvious big tech stocks, which are still well off their highs, are currently trending up and recovering, offering you exposure to the biggest revolution in technology we have seen in 100 years, or at least a few years, and they're on offer. We bought the FANG ETF. Our goal is to try and earn an annual return for our members for a year. 10% would be good. 5.77% is the average all odds. We've done 7.4% in a week. This is where it's at. Or you could invest in Australia in 25% boring banks, 25% volatile resources, and 50% of stocks exposed to 25 million boring people.
Okay.
Or you can invest in the US. So we're investing in the US. We'll leave Australia to less imaginative investors.
Well, I know our viewers aren't anything but boring, and I understand we've run out of time, or we're running a bit over time. So if you have to go, don't worry, we'll send you an email with how you can watch this on catch up. But just back to the business side of things, if everybody's happy to stick around for just a few more minutes, I am. But it goes to a question that we had from an audience member, Charles. You know, will 2024 be a year for value or tech? Because everything we've talked about, in fairness, has been very, very resourcey, very commodities based.
Yeah.
So what do you think?
Yeah, certainly not anti-tech, and we've got Microsoft in our international equities portfolio. Snowflake is one that I'd point out as well. That's in the FANG Plus ETF. That's a really interesting business on data and getting context out of data. I think it'll be a year where value comes into focus at some point and growth comes into focus at some point. So to the point about active management, I think there's, you've got to be picking stocks. I know that the bigger picture sector thematic will be key, but I just can't help but think there's going to be, when rates have done what they have done, it creates so much disparity around the haves and have-nots in individual sectors. So to me, having a real good handle on the stocks that you're owning is going to be key in FY24. To Marcus's point about Microsoft, there's about 100, I think on Bloomberg, the last time I looked, there's about 140 analysts that cover Microsoft. There's about, CBA has about 20.
Unbelievable. Yeah, I mean, the thing I'd say is I think you're going to, as clearly growth is back this year, but as the year continues to roll out, I think you are going to see these short-term gyrations between value and growth. They're kind of overused terms in my mind, but you don't need to be all in one or all in the other. You know, there are great businesses in the value part of the market, and there are great businesses in the growth part of the market. And, the thing I've learned, probably, we all learn lessons continually, is take a bit more of a generalist approach, and then have a bit of something that offsets itself when you do get those gyrations. As Marcus was saying, like tech's run hard this year. It wouldn't be inconceivable to me that when the Fed actually pauses its rate hikes, growth could sell off. Because, as counterintuitive as that sounds, because the stocks have run into the expectation of that announcement, and so often, as you see, the market does the opposite of what everyone's expecting in the short term. And I guess that maybe that's just one question for Marcus, because he said earlier, yeah, I like long-term fund, the long-term outlooks, but short-term you've got to pay attention to as well. A number of those businesses are exposed to the short-term movements in the economy. Facebook and Google, very exposed to short-term advertising trends. Amazon's short-term spending. So how do you balance that out?
Yeah.
Tesla's exposed to short-term tweeting.
Yeah.
Sure is.
Very short-term.
Yeah. Nick, any thoughts on tech versus value? And I'd be interested as well to hear from you on small versus big, because there will be this change in cycle coming, and lots of opportunities in the small end of the market.
There is, and I think if you look at the last 15 months, value and growth hasn't worked for any more than, or one particular factor hasn't worked for any more than a couple of months at a time. And I don't think that's going to change anytime soon. I think it's wrong to characterize tech purely as growth. I think the reason why tech is working year to date is because they've actually got better earnings expectations than what the market is giving it credit for. And you're seeing positive earnings revisions ahead of a whole bunch of other sectors. So you're seeing a rotation into a number of these stocks because they did a lot of their cost cutting through 2022, and their revenues have rebounded probably a little bit faster than people think. You've also got inflation still running relatively high, which is probably helping that top line as well. So I think I'm probably more in Ben's camp, that I think that these growth stocks, people are rotating because they're thinking growth is hard to come by. As the Fed starts to pause, then the market will start to price in the fact of a lower interest rate environment, and what that will potentially will do for those stocks that have suffered in a higher interest rate environment. I think small caps has been one of those areas in the market that has suffered, particularly in the last 15 months, as people have flocked to liquidity in the large cap end of the market, and as a result of that, you typically see small cap stocks lead out of recessions, and you also see small cap sectors and even emerging company sectors be significantly outperform large caps on a 2-year view, kind of post that market bottom. Now, I don't know when that market bottom is going to be, and I think we're all probably we probably will be throwing a darts at a dartboard if we were trying to guess when that would be. But we're certainly closer to it than what we were perhaps 12, 15 months ago. And as such, I think positioning for small caps in your portfolio, albeit a small allocation, is the right way to be.
All right, Nicholas, that answers your question. Did you have something to add?
I was just going to say, I think the heaps of opportunities in the small cap space, it's been unloved. I think back to the just tying in the start around having a balanced approach, whether it's equities, whether it's bonds, etc. So, and tying in Ben's point around portfolio composition, you don't have to make a bet either way. So you can have a high quality equity portfolio. You can allocate a small allocation in small caps. You can have corporate bonds in there. You can have some hybrid allocation. So it's just picking the right investments within those areas to create a well-balanced, well-rounded portfolio that is delivering good returns because the environment's changed.
Okay, no, look, we are up against the clock, but I did want to get to a viewer question, and this dovetails with a lot of other viewer questions that we had come in, and one that a sector we haven't talked about, which is retail. So for Michael, for Angela, for James, for Sharon again, at what stage or time do you think that consumer discretionary stocks are likely to become attractive? What signals would you be looking to move back into retail discretionary stocks? Or Ben, would you just stick with Wesfarmers and perhaps leave some of those other companies for now?
Oh, there's good retailers out there. I've always thought retailers are similar to mining. Well, going back to what we were talking about before, there's a small number of management teams that seem through the cycles to be able to do well. So you've got, Premier Investments is probably the golden child, but companies like AP Eagers, anything Brett Blundy's involved in tends to typically work out quite well. So I like Nick Scali, I think is another great business in the space. When does it bottom out? Probably when the news is at its most severe. The stocks are cheap. There's a lot of retailers trading on sub PEs of 10. Even JB, which would be another really well-run business, I think it's on a PE of like 9 times or something at the moment. So the valuations are there. Expectations are low. We're probably close, but you just wonder. Spend has held up stubbornly well. How much harder did the RBA go? It's probably second half of this year. I suspect that you'll get good opportunities.
Yeah, I reckon there'll be a lag effect in the what the interest rate hikes have done on consumer spending. So we probably haven't seen that. But stocks price the future. So there's pricing 6-12 months in advance. I look at something like, and we wrote about it the other day, I look at a Woolies on 28 times and I look at a JB on 9 times. I'm selling Woolies and buying JB here on those metrics. Like the elastic band has gone too far. So I'm well of the opinion that we need to be looking at retail stocks. JB's on our list. We own Wesfarmers, which is not that cheap. Premier we own. But yeah, so I think now's the time to be looking at it. And if 3 months down the track, if things get a little bit tougher, then we might allocate some more funds in there.
Marcus, you FY24 ready? Feeling pretty optimistic about the financial year to come?
Yeah, reasonably. The worst or the most negative factor for our market last year was interest rate and inflation and policy paranoia. And as of now, even though the RBA rather surprised us recently, as of now, the most major negative we seem to have hurdled for this year, in which case we've got to worry about what? A recession, a debt ceiling, the regional banking crisis. Most of those are short-term factors that are going to sort themselves out, after which, apart from recession, after which I think we will probably find that we are coming out of the bottom of a cycle, in which case we can be reasonably optimistic about the market. I don't see, I'm always concerned about the market first because there are precipitous moments. I can't see, other than an X factor which you can't predict, I can't see what is going to be precipitous about our market. Instead, I can see a general economic improvement, and that will lift consumer discretionary as well. There really are some low PEs, high yields around in that sector as well. It won't take much for brokers to all jump on them and say buy, but at the moment the consumer's feeling a bit ragged. It will come, and on that basis, I think generally for the market, yeah, pretty optimistic for the outlook from here, but ever vigilant.
Well, Marcus Padley from Marcus Today, thank you so much for joining us for FY24 Ready.
Thanks, Nadine.
And Nick Gudera also joining us from Eli Griffith. Thank you so much for joining us. Really appreciate you dialing in today.
Thanks for having me on.
Take care. All right, Ben Clark, TMS Capital, James Garish, Market Matters. Last guys left in the studio. Optimistic about FY24? You ready?
I'm optimistic. I think it's going to be a fascinating year because if we see a recession, it is the most picked recession ever, and I feel like markets are completely positioned for it. So it's sort of how those two grind against each other is going to be interesting to watch.
I think positioning is really important. To Ben's point, you look at the last Bank of America survey, the most bullish, overcreated long traders in the technology space. Cash levels are at highest point in 3 or 4 years. Defensive positioning is the highest point in 3 or 4 years. So the market is defensively positioned, and that's why when we see sell-offs, there's been buying into the weakness. So I'm optimistic. I'm always optimistic. You make more money being an optimist than a pessimist.
All right. Well, guys, thank you so much for joining us. Thank you, James, Market Matters. Look, we hope you've got some good ideas to help you get FY24 ready. I'll just actually run through what some of the ideas were from today. So for Marcus Padley, Microsoft and the FANG Plus ETF. Now we also had from Nick Gudera, Capricorn Metals and Monadelphous, and we had Deterra Royalties from Ben, as well as West Farmers, and from the team at Market Matters and James Gare, Sandfire Resources, and Worley Parsons. So please visit the Market Matters and AusBiz websites to learn more about what we do. We're all about helping you with ideas and opportunities in markets. So thanks for watching, and we'll see you soon.